Could a program designed to save Portugal's economy be the very thing destroying its future? In 2012, Portugal launched the Golden Visa to attract foreign investment, and it worked, bringing in over €7 billion. But there's a twist. Instead of revitalizing housing for locals, it fueled a market where €500,000 listings became the norm, and thousands were priced out entirely. Today, even a one-bedroom in Lisbon can drain nearly 2 times the minimum wage. Stick with me, because the data tells a story far more shocking than you've heard before. From EU funds to the housing squeeze. How did a country that once tapped EU development funds to modernize its roads, airports, and public services end up with one of the most severe housing shortages in Europe? The answer starts in the 1990s, when Portugal was rapidly transforming its economy. Billions of euros from Brussels financed infrastructure upgrades and urban renewal. At the same time, manufacturing jobs began to fade as the country shifted toward a service-driven economy. By the early 2000s, tourism, hospitality, and real estate were taking up much larger shares of GDP than they had a decade earlier. Wages did grow, but far more slowly than property values, which were already climbing in prime city locations. This new model produced visible prosperity, renovated historic centres, bustling waterfronts, and a growing international image as a safe and beautiful destination. But beneath the surface, it reduced economic diversity. The reliance on sectors that were vulnerable to both global downturns and foreign demand made the economy more exposed than it looked. Construction became a central pillar of this growth phase, feeding off both domestic speculation and early waves of international buyers attracted by cheap prices compared to other European cities. When the global financial crisis hit in 2008, it showed just how vulnerable Portugal's economic base had become. Industrial production fell, unemployment rose sharply, and the country's public finances came under extreme pressure. Real estate transactions collapsed almost overnight, taking with them thousands of construction jobs. Unlike economies with strong internal consumer markets or export-heavy industries, Portugal did not have as much to fall back on. For Lisbon and Porto, the housing market stalled, with many projects abandoned mid-construction. The apparent stability of service and tourism income proved temporary. As the country recovered in the early 2010s, those same cities would be transformed, this time at a pace that many residents could not match. Before tourism's resurgence, Lisbon's older neighbourhoods were mixed-income areas where long-term renters, often on modest salaries, shared space with small family-owned shops. In Porto, university students could rent apartments within the historic centre without competing directly with international buyers. But as foreign interest returned, the market shifted towards short-term profit, not long-term affordability. Throughout the 2000s and into the recovery years, the composition of Portugal's GDP tilted further towards services. Manufacturing's share dropped, while real estate activities, tourism revenues, and financial services expanded. Investment flowed heavily into urban property, both for domestic speculation and for anticipated short-term rental use. Meanwhile, median wage growth trailed far behind home price increases. A professional salary in Lisbon in 2005 could cover the cost of buying a small apartment in certain districts. Within a decade, the same income barely covered the rent for a similar space. In Porto, a city once promoted as an affordable alternative to the capital, home prices in the most central areas rose by double digits year after year, while average wages moved by only a fraction of that amount. This widening gap was not a sudden event triggered by one policy or market shift. It came from decades of economic choices that prioritized capital inflows and urban redevelopment without building safeguards for affordability. The post-crisis rebuilding put even more emphasis on attracting outside money, setting the stage for housing demand that would no longer be driven by local purchasing power at all. By 2011, Portugal had a service-heavy economy with housing markets primed for rapid inflation the moment investor confidence returned. All it would take was a single, carefully designed government policy to redirect that confidence straight into the property sector. And in 2012, such a policy arrived, turning an imbalance into what would feel like a sudden shock to anyone trying to find a home. The Golden Visa effect. Imagine a policy so appealing to wealthy outsiders that buying a home in your own city suddenly became a competition you could never win. That's what happened in 2012 when Portugal introduced the Golden Visa program. The official goal was straightforward: attract capital from investors outside the European Union to help a struggling post-crisis economy. In practice, it revolved around real estate. Any non-EU national who purchased property worth at least €500,000 could secure residency rights, along with the freedom to travel across the Schengen area. That €500,000 threshold didn't just set an entry point for investors, it set a hard floor for property prices in many desirable areas. Sellers, developers, and agents knew that as long as homes met that price mark, they could tap into a global pool of buyers who were not dependent on local salaries or mortgages. This is why, within a few years, middle-class Portuguese families found themselves locked in bidding wars against all cash offers from abroad. In some neighborhoods, offers above asking price became routine, and locals simply withdrew from the market altogether. The influx was measurable. In under a decade, the program generated over €7 billion, most of it through property sales. Housing transactions at the €500,000 price point didn't just rise, they jumped by roughly 60% once the scheme was in place. The immediate result was a wave of renovations and building purchases, especially in Lisbon and Porto's historic centres. Many older apartments and townhouses were gutted, rebuilt, and staged to meet the taste of international buyers. On the surface, streets looked revitalized: fresh paint, new facades, and polished interiors. But these upgraded homes rarely entered the regular rental market. Instead, they were kept as secondary residences, short-term rentals, or simply investment holdings. The logic for owners was simple: why commit to a steady but modest local rental income when tourist stays or speculative resale could produce far higher returns? By 2023, foreign buyers were responsible for around one-third of all property purchases in Lisbon. That meant that in many central districts, every third sale took one more home out of the reach of the city's residents. The human side of these statistics was clear to anyone competing for housing at the time. Stories circulated of working couples, teachers, office staff, small business owners walking away from a long-saved deposit after being outbid at the last minute. One common pattern involved a foreign buyer visiting for a week, touring multiple listings, and paying in full on the spot. For sellers, it was the safest, fastest transaction they could hope for. For local buyers, it was an impossible standard. At a national level, the Golden Visa brought in much-needed foreign currency and signaled to the world that Portugal was open to investment. It played well in economic reports and was credited with boosting the real estate and construction sectors after years of stagnation. Yet the very mechanism that made it effective for attracting capital, linking residency to high-value property, ensured that its benefits bypassed the majority of citizens. The market began to orbit around investors, not residents. Affordability was no longer anchored to average incomes, it was anchored to the spending power of someone living thousands of kilometers away. By tying a residency incentive to such a specific purchase price, the policy pushed the entire market upwards, even in areas that had been relatively affordable before 2012. Once developers realized where the demand was concentrated, new projects were tailored to meet Golden Visa criteria, with little consideration for local housing needs. This was not a sudden distortion, but it rapidly accelerated trends that had been building for years. And while this inflow of investor capital reshaped urban skylines, another force was about to magnify its impact even further. The same unoccupied or luxury properties that priced out locals were exactly the kind of spaces that could deliver the highest returns in the booming short-term rental market fueled by tourism. Tourism's double-edged sword. How can 18 million visitors in a single year fill hotels, restaurants, and shops across Portugal, yet leave so many residents struggling to keep pace with the cost of living? After the financial bailout in 2011, tourism became one of the country's main engines of recovery. By the late 2010s, it was contributing close to 1/5 of the entire economy. On paper, that level of growth looked like a success story. Steady inflows of foreign spending, record-high occupancy rates in major cities, and a global image of Portugal as a must-visit destination. Yet, the way this income is distributed tells a different story. The largest gains went to property owners, hotel operators, and landlords able to cater directly to tourists. The work created for residents was concentrated in hotels, cleaning services, transport, and seasonal hospitality roles. These jobs often paid little more than the national average wage, and, in many cases, offered only temporary contracts aligned with peak tourism periods. For those depending on them, the security and pay were far from enough to match the rising price of urban life. The expansion of short-term rentals changed housing dynamics almost overnight. By 2020, in Lisbon and Porto, more than 11% of the total housing stock was registered as short-term rental accommodation. Entire apartment blocks shifted away from serving permanent residents. In popular districts, the change was visible. Buzzing streets catered to visitors during the day, but felt hollow at night when most properties were unoccupied between bookings. The Alfama district in Lisbon became an emblem of this transformation. Around 60% of its housing was listed as short-term rental. Traditional corner stores were replaced by tourist-centered boutiques and cafes. Many existing residents found renewal notices on their doors, not because their landlords wanted to sell, but because replacing them with visitors could triple the monthly income from the same property. Once those units entered the tourist market, they were gone from the local housing supply for good. This shift squeezed the availability of long-term rentals across urban centres. For property owners, the short-term market offered yields that far outpaced what a family could afford to pay month to month. Turning to tourist rentals was a rational financial choice when a single week's booking could match or exceed a local's monthly rent. But for those without property, every apartment converted meant fewer affordable options and more competition for the ones that remained. The imbalance becomes starker when looking at wages. Tourism workers, the very people keeping this industry running, earn on average €1,200 per month. In Lisbon, median rents for a modest one-bedroom apartment have risen well above that figure, meaning anyone relying solely on income from the sector would spend more than their entire salary on housing. Even those sharing accommodations or commuting from distant suburbs face rising costs as demand pushes outward from the city centres. While tourism secures billions in spending each year, it has also concentrated profits into narrower segments of the population and made housing far more difficult to access for the majority. Cities enjoy the economic boost, yet their own residents increasingly shoulder the downsides: crowded public spaces, loss of community, and rents disconnected from local earning power. The irony is clear. The same visitors who contribute to Portugal's economic figures indirectly contribute to pushing many locals further from the neighbourhoods they once called home. This dual reality, economic gain alongside social displacement, defines the modern Portuguese tourism model. It is both a lifeline and a pressure point, sustaining parts of the economy while deepening existing inequalities. And behind these market shifts are individuals and families adapting their lives to rent increases, overcrowded public transport, and jobs that cannot support the cost of staying in their own communities. The human and demographic cost. What happens to a society when half of its young adults cannot afford to leave home? In Portugal in 2022, around half of people aged between 25 and 34 were still living with their parents. This was not due to preference for family life, but because the cost of living independently had moved far beyond what most entry-level or even mid-career wages could sustain. For many, staying at home became the only way to avoid financial instability while working full-time. The impact reaches far beyond individual lifestyle choices. Portugal's birth rate, at about 1.3 children per woman, is among the lowest in Europe. When starting an independent household is delayed by years, couples postpone or forgo having children. Over time, this accelerates a demographic decline that is already well underway. In rural areas, the effects are more visible: schools closing due to lack of pupils, small businesses shutting their doors, and entire villages with just a handful of elderly residents. Some communities have become so depopulated that local authorities repurpose abandoned homes for other uses or simply let them collapse. The working-age population is shrinking, leaving many regions short of labour. Employers in agriculture, skilled trades and small-scale manufacturing face difficulties replacing retiring workers. These shortages make it harder for local economies to remain viable, which in turn pushes more young people to leave. It forms a loop that is hard to break. That migration is not just internal. Many young Portuguese professionals leave the country entirely in search of better pay and more affordable housing. Destinations like the UK, France, Germany, and increasingly other parts of southern Europe offer salaries several times higher than those at home, often in sectors where Portuguese workers are in demand. The result is a talent drain. People educated and trained in Portugal contribute their skills to other economies, while their home country struggles with gaps in key professions. Housing costs are a clear link in all of this. In cities like Lisbon and Porto, rent for even a modest apartment can consume the entirety of an average young worker's income. Wage growth over the past decade has been minimal, leaving an ever-widening gap between what people earn and the cost of securing a place to live. Those unable to inherit property or receive family assistance face a choice between overcrowded shared housing, moving far from job centres, or emigrating. These pressures have begun to surface more visibly in public life. In September 2024, streets in multiple cities filled with demonstrators calling out the role of mass tourism in squeezing housing options. Large rallies in Lisbon, Porto, and smaller towns brought together students, service workers, and long-term residents displaced from their neighbourhoods. Coordinated across the country, these protests reflected growing frustration at policies seen as prioritizing visitors and investors over residents. The signs people carried pointed to an urgent demand for regulation of short-term rentals, limits on foreign property ownership, and more investment in affordable housing. Alongside housing pressures, there is another layer: control over the national economy itself. In several major industries, from energy to transport to large-scale real estate, foreign entities hold significant ownership stakes. While these investments boost capital availability, they also mean that profits and decision-making power often lie outside Portugal. For many, this loss of economic sovereignty compounds the feeling that the country's future is being shaped without them, and without regard for their long-term needs. All these forces, low housing affordability, stagnant wages, outward migration, declining birth rates, and external ownership of key assets, interconnect. Together, they undermine not only economic balance, but also the cultural continuity of communities. As populations thin out, traditions tied to place risk fading, and whole neighborhoods shift from lived-in spaces to backdrops for a temporary economy. The question that emerges is not just how to repair an overheated housing market, but whether Portugal can chart a path that rebuilds stability for the people who call it home. Conclusion: the same tools that once helped Portugal recover, foreign capital, real estate investment, and mass tourism, are now pushing parts of the country toward a different kind of crisis. When growth depends on forces that raise costs faster than wages, everyday life becomes harder for those it is meant to serve. A sustainable future would require rules that keep housing accessible while keeping the economy open. Think about how your own country handles outside investment and its impact on local communities. Share your experiences and possible solutions in the comments. What works where you live, and what should Portugal try next?